One of the top concerns that we hear about from our clients is the struggles between balancing savings for short and long term goals with repaying student loans that can often be an ominous cloud over attorneys as they start their careers and even as they advance well into their career. So, what I want to go through is a strategy in which we can give you a logical way to balance the repayment of your student loans in an expedited manner with the ability to save for your short term and long term goals. So, first, to do that, we need to understand student loan debt in general. So, there is a huge emotional impact to student loan debt. It's not like other traditional debts. Oftentimes, we see attorneys graduating from law school with hundreds of thousands of dollars in student loans, and they really feel like they cannot enjoy the fruits of their labor, that they cannot feel great about the career that they've started, and they don't feel great about a lot of things until they can get that student loan debt into a manageable position. Student loans, however, are not like other traditional debts that we're used to seeing, whether it be credit cards or mortgages or auto loans. Student loans are driven by government regulation, and there are a lot of really unique characteristics about the terms of the repayment, the different repayment plans. And as we've seen in recent years, these things are always changing depending on how the political winds can shift. So, what this can cause is misunderstandings about what the better strategy is for repaying student loans based on your specific situation. And if you make the wrong choices, you can lose thousands of dollars over time. So, there are two common traditional repayment strategies that most people know of intuitively. Either you make the minimum payments and pay off your loans either over a 10-year period or a graduated or extended period, or if you qualify for an income driven repayment plan, you can make the minimum payments there for as long as you qualify. Maybe you're going for forgiveness, public service loan forgiveness, whatever it might be. What I see many attorneys doing is applying the maximum pay down strategy. Pay as much as you can possibly afford, restrict your living expenses and savings for current goals, delay things like buying a house, having kids, getting the new car, that sort of thing, until you've been able to pay these loans down. And it seems like a very binary choice between either making minimum payments or really aggressively paying these loans down. And so, what I want to talk about is a different approach where we treat these student loans like an asset class in your overall investment allocation. Conceptually, we're going to take your student loan payments and we're going to add additional payments above the minimum, and we're going to use that as part of your overall investment portfolio strategy. We're going to make these things cohesive and work together. So we want to think about the interest that you're paying on these student loans as a hypothetical return, because the more you pay above your minimum payments, the more principal that you're paying down, and the less in interest that you're going to pay over the life of the loan. So you can think of this as a return on your investment in paying down the student loans. And the strategy is just to compare the student loan interest rate to the various expected returns of the various asset classes in your investment portfolio. And you're likely to find some more conservative investments like bonds that may not have a very high expected return. And maybe we could swap out the money that would go to those asset classes and instead put them towards your student loan payments. So to implement this strategy, first we need to analyze your portfolio. We need to understand what is it that you're investing in, how much of your portfolio is going to be going towards stocks, how much towards bonds, different types of stocks, different types of bonds, and understand what it is that we're going to own. Secondly, we want to look for those asset classes in which the expected return for the asset class maybe is not comparable with the interest rate that you're paying on the student loan. And we want to reallocate the funds instead of putting them towards that lower return, more conservative asset class. Go ahead and put it towards extra payment on the student loans. And finally, we want to be thoughtful about how aggressive we get with doing this. For example, if you have a portfolio that is 90% in stocks and 10% in bonds, it's probably not advisable to take the entire 10% that would go to bonds and put it towards extra payments on your student loans. You need to maintain some sort of liquidity and ballast and low risk, relatively low risk exposure in your investment portfolio. So, what are the potential pitfalls? It's really all about maintaining balance and liquidity. So, if you allocate too much to the debt, you can run into a problem where you cannot go sell that investment that you've made in the extra student loan payment to recover cash if you need it. If you hit a bind and you need to raise cash from your investment portfolio and it's not a good time to sell stocks, you're not going to be able to go back and get the student loan repayments back, and you're not going to have any of your other lower risk investments available to sell in your portfolio. So these payments that you're making to the student loans are irreversible, and so you want to be thoughtful about just how much you put towards them. And finally, it's just the next order effect of this is the liquidity constraints. You have to maintain adequate liquidity in your investment portfolio such that this strategy doesn't put you back against a wall in times when you need cash or need to rebalance your portfolio. So the key takeaways are student loans are unique in nature relative to other forms of debt. They are governed by laws and regulations, which are frequently changing, being added to and modified. And so we have to keep pace with what's going on out there. Balancing your student loan repayments and your savings is incredibly important. And this gives us a very logical way to do it by treating your student loan repayments as an asset class along with your long-term investment portfolio, so that as you're allocating dollars to both buckets, it's one cohesive strategy. And finally, we want to make sure that we maintain flexibility with our investment portfolio and how we allocate to these student loans, because again, once we make those payments to the student loans, that cash is gone and we're not able to get it back. And so of course we have to make sure that we have adequate flexibility and liquidity in our investment portfolio as we deploy this strategy. We'd love to talk to you. If this is of interest to you, please get in touch. You can email us, you can schedule a call, or you can read our blog. Thank you.